Hello, and welcome back to Investing Fundamentals for our fourth episode. As we approach the end of the year, today we will dive into the intricacies of capital gains tax. Capital gains tax, by definition, is the tax incurred when an investor sells an asset based on the appreciation of that asset during its time in their possession. Investors can find themselves subject to either short-term or long-term capital gains tax, depending on how long they've held the investment. Short-term gains are taxed at an individual regular income tax rate, which is typically higher than the rate for long-term gains. This creates an incentive for most investors to hold their investments for at least a year. Now, irrespective of the holding period, once the asset is sold, the profits become realized gains. Luckily, there is a strategy to minimize the financial burden of capital gains, which is tax loss harvesting, sometimes known as tax loss selling. It involves strategically selling securities at a loss to offset the capital gains tax owed on profitable assets. If one of your investments show a decline in value, you can sell it to offset the gains from other assets. Many investors employ this strategy towards the end of the year when they assess their portfolio's annual performance and its implications for their tax liability. One effective way to participate in tax loss harvesting can be through a separately managed account. This offers managers maximum transparency and control over individual assets, in contrast to mutual funds or other pooled investment vehicles where you own a share of the fund's asset value. It is very important for an individual investor to understand these dynamics or to work with a financial institution that is well-versed to ensure your portfolio is well-positioned to manage the burden of capital gains taxes. Thank you for joining us, and please don't hesitate to reach out to our team if you have any questions. Stay tuned for more insightful episodes.